DoorDash hopes to raise as much as $2.8 billion.
Cheers broke out Friday as Uber became a publicly traded company.
15 years ago, a small internet company named Google went public.
This is an awesome moment.
This is what an IPO looks like. The bell, the confetti, the moment a company finally makes it. But here's what you're actually watching. When DoorDash went public, $2.3 billion disappeared in 24 hours. Not stolen, not lost, transferred to people who were never supposed to share it with you. Everyone thinks an IPO is a company raising money, and it is. But it's also something else, a wealth transfer mechanism with clear winners and losers. And if you're watching this video, you're almost certainly on the losing side. We've all heard the stories. Amazon went public at $18, Apple at $22, Google at $85. If you'd just gotten in early, you'd be rich. And that's the promise of the IPO. The idea that ordinary people can participate in the next big thing. There's another version of this dream too. Work at a startup, get stock options, wait for the IPO, change your life. These stories aren't entirely false. They happen, but they're not the whole truth. Since 1980, companies going public have left on the table $237 billion. That money didn't evaporate. It didn't go to charity. It went somewhere very specific, and the system was designed that way. There's a professor at the University of Florida named Jay Ritter. For 45 years, he's tracked every single IPO in America. Wall Street calls him Mr. IPO, and his research reveals something that should make you angry. In his words, underwriters want to underprice excessively. Want to, not accidentally do, want to. To understand why, you need to see how an IPO actually works, not the version they show on TV, but what happens in the rooms you're never allowed into. Months before that bell ever rings, the real IPO happens. And it happens in places you'll never see. It's called the Roadshow. For 2 weeks, the CEO and CFO of a company about to go public fly from city to city on private jets. New York, Boston, San Francisco, London, holding 50 to 80 private meetings with institutional investors. These aren't public presentations. There's no live stream, no sign-up form. These are private sales meetings, by invitation only. During these meetings, the investment banks running the IPO, Goldman Sachs, Morgan Stanley, JP Morgan, collect what they call indications of interest. How many shares do you want? At what price? And here's the key question. If we give you shares, will you hold them or will you flip them? For a hot IPO, demand is 30 to 50 times the available supply. That's not an accident. The banks engineered this scarcity. They want more buyers than shares because it gives them the power to decide who gets in. So who gets shares? Simple. The investors who generate the most trading commissions for the bank. The ones who provide helpful information about what other investors are doing. The ones who promise to buy even more shares once trading starts. It's a rewards program, but you're not a member. When the allocation is finished, roughly 90% of shares go to institutional investors. Retail investors, people like you, get maybe 10%. And even that requires jumping through hoops. Fidelity, for example, requires $500,000 in assets just to participate in most IPOs. The guest list is finalized before you even know the party is happening. The night before the IPO, there's a meeting. The company's executives sit down with their investment bankers to set the final price. This is the moment that determines everything. The bankers have spent 2 weeks collecting demand data. They know exactly how much investors are willing to pay. They could price the stock at the market clearing level, the price where supply meets demand. But they don't. They deliberately price it lower. Let me show you what this looks like in practice. December 2020, DoorDash. The banks priced the stock at $102, but when trading opens, it immediately jumps to $182. That's an 86% increase in minutes. The financial media calls this a successful IPO, a hot debut. But let's do the math. DoorDash raised $3.37 billion, but if they'd priced at what the market was actually willing to pay, they would have raised $5.5 billion. That's $2.3 billion that went straight into the pockets of the institutional investors who received the allocation at $102. The same week, Airbnb goes public, priced at $68, opens at $146, $4 billion left on the table. 1 week, 2 companies, $6 billion transferred from the companies going public to the institutional investors, and the banks who made it happen, they got paid by both sides. Jay Ritter's research shows the average IPO leaves $9.1 million on the table, roughly twice what companies pay in direct underwriting fees. You're not just paying the bank to take you public, you're paying again by giving their best clients a guaranteed profit. So why would banks do this? Why underprice the stock when their fee is a percentage of the money raised? Because their institutional clients, the ones getting IPO allocations, are the same clients who trade with them every single day. Fidelity, BlackRock, Citadel. These firms generate billions in commissions for the banks. The IPO allocation is a thank you gift, a reward for loyalty. The bank isn't really working for the company going public. They're working for the buyers. And here's something remarkable. The fee banks charge for IPOs, around 7% for mid-size offerings, hasn't changed in 40 years. Everything else in finance has been disrupted. Trading costs have collapsed. Information is free. But the IPO fee? Frozen in time. An SEC commissioner called it the 7% IPO tax, and nobody seems interested in changing it. Now we arrive at the day everyone celebrates. At 9:30 a.m., DoorDash is worth $102. At 9:31, it's $182. In 60 seconds, $2.3 billion moves from one group of people to another. Here's what's happening. The institutional investors who got shares at the offering price can sell immediately. Many of them do. They capture the pop, that first-day jump, and move on. They're not investing in DoorDash's future. They're collecting a fee for being on the guest list. Meanwhile, retail investors, you, can finally participate. But by the time your order goes through, you're not buying at 102. You're buying at 182. You're not getting in on the IPO. You're providing the exit for people who did. Nobody asks the obvious question. Who got those shares at $102? And who's buying from them at 182? But there's another group watching this celebration who can't participate. The people who actually built the company. When a company goes public, employees are typically locked in. They can't sell their shares for 180 days, sometimes longer. This is called the lockup period. In theory, it prevents a flood of selling on day one. In practice, it creates a trap. Take Uber, May 2019. The company goes public at $45 per share. Employees who've worked there for years, who took lower salaries in exchange for stock options, finally see their payday on the horizon. They just have to wait 180 days. So they wait, and they watch. By November, when the lockup finally expires, Uber stock has fallen to $25.58, down 43% from the IPO price. The day employees can finally sell, 545 million shares flood the market. The stock hits an all-time low. But it gets worse. Those employees don't just lose money on paper, they owe taxes. Here's how it works. When restricted stock vests, you owe taxes on the value at that moment, the IPO price. So if you received $300,000 worth of stock at $45 per share, your employer withholds about $66,000 for taxes. But that's only 22%. If your actual tax rate is 37%, which it often is at these income levels, you owe another $45,000. That bill comes due in April, but your stock is now worth 43% less than when the taxes were calculated. Some Uber employees had to sell at a loss just to pay the tax on gains they never actually received. The people who built the company are trapped. The people who hyped it walk away rich. At this point, you might be thinking, okay, but what if I just buy and hold? Skip the day one hype, wait for the dust to settle. Eventually, I'll win, right? The data says no. Jay Ritter's research shows that IPOs underperform the market for 5 to 6 years after going public. And here's the kicker. In the 1980s, about 20% of companies going public were unprofitable. Today, that number is 80%. You're not buying the next Amazon. Statistically, you're buying a money loser. Now, here's the thing that makes all of this even more frustrating. There is another way, and Wall Street hates it. It's called a direct listing, and in 2018, Spotify did something that made investment bankers very nervous. Instead of hiring banks to underprice shares and allocate them to preferred clients, Spotify just listed their stock. No artificial scarcity, no rewards program for institutional investors, no 7% fee. Spotify saved roughly $34 million compared to a traditional IPO. Coinbase, Slack, and Palantir followed the same path. So why doesn't everyone do this? Because banks have no incentive to support it. An analyst named Matt Kennedy put it bluntly. Banks have no incentive to support this deal. They lose their fees. They lose their allocation power. They lose control. Direct listings still represent about 1% of companies going public. The alternative exists. It's just not for most people yet. So why does this system persist? Because everyone who matters is winning. Banks earn billions in fees, plus control over who gets access to deals. Institutional investors get guaranteed first-day profits, venture capitalists get liquidity for their funds, founders get their payday. The only people losing are retail investors who buy after the pop, and employees trapped in lockups watching their paper wealth evaporate. But those people don't set the rules. So what do you do with this information? You could avoid IPOs entirely. The long-term data actually supports this. You could wait 6 months for the lockup to expire, for the insiders to sell, for the real price to emerge. Or you could just recognize what you're actually watching when that bell rings. The IPO isn't an invitation to the party. It's the exit door for people who got there before you. Next time you see that bell ring, ask yourself, who got shares at the offering price, and who's buying from them right now? If you found this useful, subscribe. I break down how systems really work,